Hi everyone, good evening. This evening I'm going to talk about the accounting cycle. There's some of the initial steps of the accounting cycle. So what is an accounting cycle? Accounting cycle includes all the steps of the accounting process of accounting information systems. So in the US textbooks, we use a 9-step accounting cycle. In some other parts of the world, it could be as few as only 4 steps. So I'll explain those to you as I go. So let me first introduce the 4-step accounting cycle. When you use the 4-step cycle, you mean transactions recording or recording transactions in the journal, posting them onto the ledger, summarizing them in a trial balance, and preparation of financial statements. So that makes it a 4-step accounting cycle. Quite simple: journal, ledger, trial balance, financial statements. Then it could be extended into a 5th step, which is analysis and interpretation of financial statements. So like back home in Bangladesh, we used to learn a 5-step accounting cycle: journal, ledger, trial balance, financial statements, and analysis and interpretation. But in the US, we are more thorough and we use a very extensive, exhaustive accounting cycle, which is a 9-step accounting cycle. So let me go through those 9 steps with you. Step number 1 is called transactions analysis. We use a tool called the accounting equation. Step number 2 is recording transactions, and the tool used is journal. Step number 3 is classifying transactions. The tool used is the ledger. Step number 4 is summarizing transactions. The tool used is the trial balance. And then step number 5 is adjusting the trial balance accounts, trial balance account balances. The tool used is some journal entries again, called adjusting journal entries. So that leads us to the 6th step, which is an adjusted trial balance. So I'd like to draw your attention to this at this point, is that step number 4 to 6 is basically one step. You can combine these 3 steps into one because you're essentially working around your trial balance. So you start off with an unadjusted trial balance, then the following step is adjusting journal entries, because you are finding inconsistencies, you're finding imperfections or errors in your trial balance, so you make adjustments. And to make any adjustment, you need more journal entries. So when you do more journal entries, that means your ledger balances are going to change. And with those new balances or revised balances, you will have to prepare a fresh trial balance, which we call an adjusted trial balance. So that's our step number 6. Step number 7 is preparing financial statements. So that is actually the most robust step of the accounting cycle. I call it robust because this is the actual deliverable. This is what you have been working for last 6 steps, because this is the output of the accounting process: financial statements, external financial reporting account. Then step number 8 is closing the account. So the tool used is again some closing journal entries. That leads us to again some new balances, which would only leave us with a post-closing trial balance. So step number 9 is our post-closing trial balance. So let me show you those steps here. As you can see, so there we go. Our step number 1 is analyzing transactions or transactions analysis. And you can see the tool here. So beside each step, I'm showing you the step, the tool that we use. The tool is the accounting equation. This is a very powerful tool and very sound, very time-tested tool of accounting. Accounting equation, which is used to analyze transactions. Then recording. And where do we do the records? We do the recording in the journal on a chronological basis. Then classifying transactions, and the tool used is ledger. Then we have summarizing transactions. The tool again is a trial balance. Adjusting the accounts, adjusting journal entries. That leads us to an adjusted trial balance. Then the next step is preparing financial statements. preparation of financial statements, income statement, stockholders' equity statement, balance sheet. So these three are primarily prepared. And then, of course, we now prepare a cash flow statement as well. Number 8 is closing journal entries. The tool used is journal entries again. And finally, preparing a post-closing trial balance. All right, so these are the 9 steps of the accounting cycle. And in this video, I'm going to talk about the first step, the accounting equation, how we use the accounting equation to analyze transactions. So if you like to see the accounting equation, you can say this: assets equals liabilities plus owner's equity. So this is the basic accounting equation. That means at any point in time for any entity, your assets would be equal to your total of liabilities and stockholders' equity. And that means that you can manipulate this equation. That means assets minus liabilities would be equal to your equity. Equity is the owner's claim in the business, owner's residual, the value of the residual ownership. That means whatever assets I have, if at any point in time, if I wind up my business or if I want to have a valuation of my business, then I'd look at the value of my assets and I subtract the value of my liabilities, because in these assets, there are two parties, the owners and creditors. Both parties have a claim. They have claims. So assets are there to first pay off our liabilities, and after paying off our liabilities, whatever is left is owner's equity. It belongs to the owner. Now this accounting equation could be extended to make more sense. Like, how do you deal with revenues and expenses? So I'm going to include revenues and expenses into the accounting equation now. So that leads us to this second equation. You can see here we have assets equals liabilities plus capital plus revenues minus expenses minus dividend. So from here, apart from liabilities, the whole thing is actually owner's equity. So if we split owner's equity or stockholders' equity, we find capital plus revenues minus expenses, which is going to be net income. You can see the final one. Revenues minus expenses is what? Is equal to net income minus dividend. So the whole thing here, apart from liabilities, is actually an extension of stockholders' equity. So this is what we use, but how do we use it? What happens, we have some rules for determining debits and credits. We say that whenever an asset goes up, we debit it. That means whenever an asset goes down, we credit it. Asset going up is debit, assets going down is credit. And for liabilities and equity, the rules are different. The rules are opposite. So when a liability goes up, we credit it, and when a liability goes down, we debit it. And the same, likewise, we do the same for stockholders' equity. Equity going up is credit, equity going down is debit. So let's now look at some transactions and see how we record them in the journal. Here are some transactions. Transaction number 1 is that Karim, I'm using my own name, Karim starts a business with $5,000 of capital. Check again. I'm starting a business with $5,000 of capital. So that means with this transaction, the business's assets are going up by $5,000, because before I started the business, there was no business. So if there was no business, that means there was no assets, no liabilities, and no equity either. But when we have started the business, I'm contributing $5,000 into the business. So that means the business is receiving some money. So the business's assets gone up. At the same time, the equity, stockholders' equity, has gone up. So stockholders' equity means stockholders' claim into the business, in the business. So when assets go up, debit, equity goes up, credit. So we have a journal, and this is the journal: cash debit and capital credit. If instead of contributing cash, if I contributed some physical assets, say I started my business with $5,000 of capital, $5,000 of cash, plus a laptop computer, plus some furniture, plus some intangible assets, maybe a customer list, or some software or whatever, I contributed into the business. So all those assets that I'm bringing into the business are debits because the business is receiving those assets. The business's assets are going up. So when assets go up, those are debits. And at the same time, right now there is no liability because the business owes nothing to anyone else but me. So whatever the business owes to me is actually my equity. So my capital would have gone up for the total, the combined value of those assets. Look at my second transaction. Let's say after starting my business, I apply for a new trade license. So Karim applied for a trade license, paying $150. So how does it affect my equation elements? If I spend $150, my cash would have gone down, assets gone down, and licensing is an expense. So this is our debit, this is our journal, debit licensing expense, credit cash. Check again. We spent $150 to apply for a license. So this licensing, I call it an expense. You could also call it an asset because it's going to be a long-lived asset. It could be an intangible asset. So you could define it as licensing. And so in that case, don't use this affix of expense. We call it trade license. So in that case, trade license would become an intangible asset. So we debit trade license and credit cash. My next transaction is buy supplies for $50. So now we have a business, we need supplies, we need pen, paper, pencil, calculators. So what happens when you buy supplies and pay $50? First of all, one asset is coming in. The asset that's coming in is supplies, and the asset that's going out is cash. So assets coming in is debit, assets going out is credit. Therefore, the journal is supplies debit and cash credit. Check it. So this is how you record your transactions into a journal. We're going to talk about more transactions later. Thank you for your patience. Thank you. Bye-bye.